All right, we're live. Welcome to Be the Boss of Your Money. I'm Mitch Goldberg. Thank you so much for joining me. We've got a couple of things to go over. Interest rates are surging, but all of a sudden, stocks seem like, maybe they're holding up okay. It's almost like maybe they got used to it. We're going to talk about that in a moment. We're going to talk a little bit about some stocks that are actually surging right now. We're going to take a look at the stocks that move the Dow Jones Industrial Average. They're big blue chips, so it always pays to look at those. And we're going to talk a little bit about some retirement mistakes, in particular, something called IRMA and some tax strategies which you should be aware of when you retire. More importantly, these are the to even worry about these tax strategies. There are things you need to do now before you retire in your 30s, 40s, and 50s. And it goes above and beyond just putting money into your retirement plan. Of course, that is the most important thing. So we're going to roll the quick intro. Let me find where the intro is. Okay, here it is. We're going to do this. We're going to move fast. So stick with me. You have any questions? You know what to do. Ask me in the comments. I love hearing from you. It's the best part about what I do. Also, if you like what you see here, give us a thumbs up. Maybe share the live stream. If you're watching in the replay, same for you. Give it a thumbs up. Ask me your questions in the comments. When you give us a thumbs up or just even say hi in the comments, it helps spread the word all over with all the algorithms about the good work we're doing here. Your friends will see it, and it just would be, greatly appreciated. It would be a big deal for the show. Here we go. All right, we are back. Everybody wake up. It is time for money. I did it again. It's time for Be the Boss of Your Money. It's your post-market show. We talk a little bit about the market, the day's action. We get some lessons, some insight, and we give you a little bit of education. We send you on your merry way, and that is just a beautiful thing. A couple of little tidbits of information that are on my mind. You are always on my mind. Okay. Okay. So a couple of things. We're going to go through the markets. First, let's take a look at the important stuff. I'm going to get rid of the icons. Go here. All right. We're going to make this a little larger. Make sure you can see that. Okay. I am on bankrate.com. And you see mortgages, 6.7, 6.875. This is for people with good credit, some upfront costs, 6.6. These are some, I've heard of TD Bank, 6.875. Citizens Bank is 6.75. I'm pretty sure by tomorrow, Bank of America still says it's 6.5. This is, I think this is even with points. But when I go here, and I look over here, okay? If you see this, make it nice and big so you can see it on your smartphone, all right? The 30-year mortgage rate, average, this is average for the country, not just New York State, 6.94%. The 10-year yield, which is something that I talk about all the time here, finally, it briefly touched 4%. Now, we were in the 4% range late last year, and it didn't hold. But when it went to 4%, mortgage rates went above 7%. And as you can see, today housing numbers came out. Actually, yesterday housing numbers came out, and pending home mortgage applications were down to like a 28-year low. It's really taken a toll on the housing market. And it's not just first-time home buyers and move-up buyers, it's investors as well. It's changed the dynamics. It's basically a mortgage payment is about 40% to 50% higher today than it was a little bit over a year ago. So it's wreaking havoc on the mortgage market. So 4% 10-year yield is roughly a 7% on the 30-year mortgage, give or take a few tenths of a percent. And we could see that go up to higher, maybe 7.5 or 8% on a 30-year mortgage. Now, I scour Zillow, Realtor.com. I look at this stuff all the time. I'm looking for a condo to buy and to rent. And I look at the prices, and, sellers are just not lowering their prices. And they keep showing these comparisons to like a year ago and 6 months ago, price comparison 6 months ago, in the same development for a similar condo. And I don't think sellers have gotten real about it. Certainly, if you have a mortgage that's like 2 or 3 or, sub 4%, you're not going anywhere. I mean, that's just like, why would you move so you could lock in a much higher rate, pay a much higher mortgage payment, and buy a more expensive home? And that certainly does affect people who want to, downsize. You talk to anybody, especially where I live on Long Island, you talk to anybody who is like 60 plus who wants to downsize, move into a less expensive home. Like, what a lot of people are finding is that their family home that they're going to sell for 700,000-800,000, the place that they want to buy is also 800,000, but they're going into a condo, like a 2-bedroom condo. It's really hard to scale down at this point. And there is a lot of demand in my neck of the woods for condo developments, because it's a way that empty nesters could actually hopefully scale down, move into a less expensive house in an area with more amenities, people around, and not have to worry about cutting the lawn and also lowering the real estate taxes. But it's still pretty competitive out there. I'm just debating if sellers are getting real about prices or not. I mean, something has to give. So I just, nationally, home prices in the last year are down about 4%. But that's nationally. That includes areas like Austin and Boise, where prices have fallen a lot. But I don't think that really reflects areas where there's just a lot less land to build, like downstate New York, almost the entire state of New Jersey, and suburbs of major cities in around Philly and Pittsburgh. So that's that. Let's take a look at how things did in and around the world. That's it. Okay. So the Dow, which was up a little, then down most of the day, recovered right at the end of the day, up 5 points. NASDAQ was still off a bit, down 76 points, still less than 1%. S&P down 18 points, down about 0.5%. Gold, it's just basically going back and forth in this range for a while. Oil up a little bit, 77. It was 75 the other day. So oil seems to be creeping up a little bit lately. Tough to say. Is it because China is reopening and they just have a lot more demand for oil? China is just getting a lot of oil from Russia. It's cheaper oil. So, it's not like there's like a shortage of oil. It's just the dynamics have changed. But our oil here, West Texas Intermediate, is still a good deal cheaper than Brent, which is about 83, 84 bucks a barrel. Anyway, the 10-year yield, like I said, was up. It's closed, went out today at 3.996%, just about 4%. So I expect it to breach 4% and not just broach 4%. And the VIX is 20.58. Not really doing much of anything. With all the volatility of February, because today's March 1st, so we ended the month February. The Dow is off a little over 4%. NASDAQ was off about 1%. I think the S&P was off, just off the top of my head, like 2.5% on the month. But the VIX is held steady between 18 and 22. It's not showing signs of cracking in the market. All right. Let's take a look at the bond yields. Pretty much across the board are up. You're continuing to see the 5s and the 6 month and the 1 year. It's just a very compelling case to say, I'm going to invest in a 6 month or a 1 year treasury at 5% plus. It's guaranteed. It's safe. It is free from state income tax if you're in most of the state. One of the most states have a state income tax. It's a pretty good deal while you wait for something to happen with the market. All right. So not a bad place to be. So I've been buying for clients 6 month and 1 year T-bills as a good place to put some money that we might deploy into the market at a better time. I'm doing the same thing. I'm just saying not everyone's last penny is going to go into the stock market. And certainly have clients with an allocation toward fixed income and cash. So these are very helpful getting yields these high for the first time in over 10 years, in 15 years, actually. So it's just a big help. Like I have clients who are like, wow, I can't believe how much money I'm making. My account's doing so well. Yeah, because you're finally getting money on your cash. I've been cash heavy, bond light, because I was always worried that interest rates would go up and bond yields, bond prices would go down. That's exactly what happened, by the way. It happened a lot. Last year was the worst year ever for the bond market in terms of price performance. I mean, I don't know how people dig themselves out of that hole. Short of interest rates going back to zero, I don't know how you reverse the losses you suffered in the bond market last year. But if you listen to the show, you know that we avoided long-term bonds because we were worried about duration risk for many of you. It's not a recommendation, it's just how I feel about the vagaries of trading the bond market. Does that make sense? Okay. If you look, though, up to 20 years, everything is over 4% to the 20-year treasury bond, except for the 10-year. Why the 10-year isn't like 4.1, 4.05, 4.1% is beyond me. There are just still a lot of people that own it that are not letting go of that bond. Let it go, people. Let it go. Let rates go higher. Let the magic happen. Let the economy slow down. Yeah, I know it's not good magic, but we get a slowdown in the economy. The Fed starts to say, we've done our job. We could start to pause interest rate hikes and maybe even pivot. We'll see. March 10th is the next big non-farm payroll number, and that's going to really tell us what's happening, if the Fed's going to stay aggressive or not. Last payroll, we saw 517,000 new jobs created, but we need that to get down to maybe 200,000. And then we'll have something to talk about in terms of inflation going down, and you'll see wages per hour, hourly wages start to level off. I don't think things are going down. I just think, they just will stop going up. Look, if prices stay here where they are now, you'll say that's inflation. But inflation is not looking at where prices were 2 years ago. It measures how much they're up from a year ago. So if prices just stay flat now, and then next month they're flat, then we say, wow, inflation is moderated. Okay? So that's how inflation is going to work. It doesn't mean we go back to pre-pandemic prices. And the reason we're not going back to pre-pandemic prices is because of what's changed. We're in an era that nobody knows about. I mean, you might know about it, but we don't know how it's going to be, how we're going to react. The era we're in now is the end of globalization. I'm 55 years old. I can tell you, everyone has been in an era of globalization since World War II. The United States, using its Navy, freedom of navigation, maritime laws, international waters, okay? Since World War II, we have policed the oceans to make sure we have freedom of navigation. And it was worth paying for that because we got our oil, we got our commodities, and we had the ability to sell stuff overseas. That is changing. And one of the reasons that's changing is because we have so much oil and natural gas reserves here in the United States that we could pull back from globalization. We could actually manufacture a lot more stuff here for cheap because we actually have cheap electricity. We in the developing world, the developed world and the developing world, in the whole world, our competitive advantage is we have the cheapest electricity now. It's going to be cost effective to bring more and more goods production here. like semiconductors, the CHIPS Act, which is basically going to crush China's economy. China's good at making low-end chips, like the kind of chips that go into a toy, or a chip that goes into like a kid's sneakers. It makes the sneakers light up when the kid bounces in the shoes. That's low-end stuff. But medium and high-end chips, that stuff is either made here in the U.S., South Korea, Taiwan, Japan. So the high-end market's going to continue to do well, and we're going to make more and more of that stuff here too. Believe it or not, China is not a technological equivalent. They're not a technology manufacturing equivalent to the United States. They're great at ripping off intellectual property, but even with that, they still need foreigners to supervise and support and build their high-end factories. It's just what we're good at. I could go on to a riff about the end of globalization for so long. Globalization is going to end rapidly, but COVID certainly accelerated that. And then the war in Ukraine greatly accelerated that. And it's going to cause supply chain disruptions all over the world. I don't just mean like for cars coming to the United States, but the movement of raw materials, of lumber, titanium. It's going to affect everything, and we're not really sure what the ramifications are going to be. And a lot of countries are going to find themselves without imports that they actually need for their economy, for their livelihood, for their health and their safety. So a lot has changed, and the United States, I think, is going to be in a position where we don't have to do freedom of navigation as much as we did. I really think the Middle East needs to be, not including Israel, the Middle East countries need to be very careful, because if we don't need their oil and we don't need to enforce freedom of maritime law and international waters in their waters, well, what are they going to do? Are they going to do it themselves? Good luck with that. Okay. But I digress. I'm all over the place. I admit it. Okay. Today, the market foe was Lowe's, down over 5%. So Lowe's down over 5%. They see soft sales. They see a consumer pulling back. They see the housing market, has leveled off. They see that people who bought houses during the pandemic, which is a lot, it was a hot market, and those people are in their houses. They've done their projects, and now, Lowe's and Home Depot have to rely on people's maintenance, home maintenance. But home maintenance is a very slow, steady, annuity-like revenue stream for Lowe's and Home Depot. But there's nothing like the rush of spending that happens when you move into a new house and you've got to just redo everything and fix up everything, and you want to get it all done at once. You want everything, the new carpet, the new paint, the new kitchen, the new toilets, the new whatever it is that you do in the house, you want it done right away, as opposed to just once you do everything, now it's maintenance for the next 20 years until you sell the house. And then the next buyer gets to do all that stuff again. See, that's how it works. The Hero Aftermarket, this is huge. Salesforce.com up $25. Spectacular numbers, good forecast. Stock is up 15% after market trading. The stock was obviously oversold. I say that because why else would it go up so much? But between today's trading and aftermarket, the stock is up about $28. That is a huge move, and this is a Dow component. So this should have a nice impact on trading tomorrow and maybe help set us up with the first positive week in a couple of weeks. All right. So I think that's really about it. Oh, here's something else I want to get into. We're kind of running out of time, and I went over, but I wanted to talk to you about Medicare. This is the Medicare.gov site and Social Security. This is the Medicare Income Related Monthly Adjustment, or also known as IRMA. And I have this form which actually gives you the modified adjusted gross income levels to where you have to pay more for your Medicare. And a lot of people just don't understand this. And it's important for you to understand that when you get into retirement, you've got to do a lot of tax planning ahead of time. Once you're in retirement, tax planning is really hard because you're relying on taking money out of your retirement accounts And if your retirement accounts are regular, traditional IRAs, you rolled over your 401k into a traditional IRA, there's not much you could do with tax planning when you take that money out. You just have to take the money out, and it's income, and you pay taxes on it. And it raises your adjusted gross income, your modified adjusted gross income. You make more money. All right, a lot of people think, money for my IRA, that's not, taxable income. Yes, it is. It counts just like income as if you had a job. So that's why I keep talking about Roth IRA conversions, because if you can start moving some money into a Roth IRA ahead of, collecting Social Security and Medicare, you'll be able to take a combination of money out between your traditional IRA and your Roth IRA to help pay your bills. But because of that combo, you could lower your tax burden, lower what you have to pay for Medicare. It's a big tax trap that people get into that they don't think about until they start collecting Medicare. So what we want to do as financial planners here is we want to get you prepared for that early. These are the kind of things that we talk about. These are the kinds of things we work into your financial plan. And, you'll thank us 20 years from now. Okay. That's about it for the show. So much to talk about in so little time. I hope you like what you see here. If you want to reach out to me and have a direct one-on-one conversation, send me a DM, reach out anytime. I hope to continue the conversation with you. And, if you're already working with someone, that's great. But if you're looking for somebody new, definitely give us a call, give us a shot, have a conversation, and we'll see if we're a good fit. All right, that's it for the show. I will be back I'm not going to be back tomorrow. I actually am going out for the afternoon tomorrow. I'm looking at some office space to move our office to our new headquarters. I'm very excited about it. So I will be out for the afternoon. So unless anything crazy happens on Friday, I'll be back to you on Monday. Don't forget, Money in the Morning radio show will be every morning live, Monday through Friday at 9 a.m. Actually go on at 9:07 a.m. Thanks again. Have a good night.